Good afternoon and welcome to our 2025 Direct Property Perspectives. It's a real pleasure to be here in what is our most important investor event of the calendar year for the direct business. It's a time myself and the team truly value to get in front of our investor customers, give you an update, not only of the 12 months that has just been, look ahead, what we expect to happen, and to hear from some of the best presenters and knowledgeable property experts in the market. But it's also that time where I need to tell you, nothing myself or any speaker says should be taken as financial advice. This is an educational event, but we will be talking about products, and if any of the funds are something you're interested in, we always tell you and encourage you strongly to read the offer document in full, focus on the risks section, and speak to your financial advisor if relevant. And I'm very excited today. I think this is the best lineup of speakers we've ever had for the Sydney Luncheon. You're going to hear from our Group Managing Director and CEO, David Harrison, who'll give you an outline and a few of his thoughts. You're going to hear from Samir Chopra, Head of Research, Asia Pac for CBRE, who's going to give you his perspectives and CBRE's on what the outlook presents like for commercial real estate in this country. I'm then going to give you an update on the direct suite of funds, and then I'll invite to the stage Carmel Hourigan, our office CEO, and Anna Maras, Head of Asset Management for Industrial Logistics, to get these sector experts' views on the office and industrial markets. But before we do that, I want to set the scene. This is a great turnout, and firstly, I want to thank you all for taking the time to be here with us today. And for many of you in the room who have been long-term investors, I want to thank you for investing with Charter Hall. And the past 12 months has been an interesting period for the commercial property market. We've witnessed a recalibration, and that's a good thing. Things have started to move in the right direction. We've witnessed stabilising cap rates and even slight compressions in sectors such as industrial logistics, convenience retail, neighbourhood shopping centres and Bunnings. The office discussions with tenants continue to move in the direction where tenants are asking about taking more space. And that's despite some of the sensationalist headlines, I'm in Sydney, I feel safe saying this, from premiers south of the border who are putting forward different perspectives on how they think private businesses should run their enterprise. I also should highlight, I've taken a sneak peek at Samir's deck. He's going to give you an overview of where the industrial logistics market in this country sits on a global perspective. And I think you're going to be pleasantly surprised when he shows you where those vacancy rates sit for all the key markets in Australia. The neighbourhood shopping centres and Bunnings, well, they're going from strength to strength, despite them also coming off a period of recalibration in cap rates. And I also want to take this time to remind you, not only are Charter Hall the managers and focused on driving performance, but for many of the funds, we also co-invest alongside you. And if I look at funds such as DOF and PFA, we're the largest single investor in these funds. And rest assured, myself and the team are very focused in driving that growth in unit price over the medium to long term. And so I thought I'd set the scene a little bit more with a few slides. This is what it looked like 12 months ago when I stood up here. This is the MSCI amalgamation of all the core real estate sectors: office, industrial logistics, retail. Pretty bleak. Things were still trending down. I stood up and said, well, we think convenience retail will bottom first, followed by industrial logistics, and then through the office sector. I should also highlight what this doesn't show. This is just movements in capital value. This does not show the regular income that the funds and properties continue to pay. But let's fast forward. This is where we're at today. You can see the trend has clearly changed. And because this is an average, this is really only sitting below that benchmark, the 0 point, because of what's happened in the office sector. This next chart, I think, shows where we're at in the cycle, hopefully very easily. And whilst we can quibble on whether it's convenience retail or industrial leading the way, what I do want to draw your attention to is we are in that recovery phase. We had the RBA cut rates for the third time yesterday, down to 3.6%. And in this recovery phase, things that we typically see, reduction in interest rates, stabilisation of yields or cap rates, and you begin to see that buyer depth in the physical markets emerge and transaction volumes increase. And even the office sector, you can see here, it's transitioning. And whilst 30 June we did see some slight devaluations, the drop has materially declined. And one of the key things a number of our speakers are going to cover off today is what is happening in the supply outlook. I'm sure you all read the papers, you watch the news, you understand, you're aware of the challenges in the residential space, how hard it is to bring new supply to market, how much it costs. Builders are going broke, planning, challenges everywhere. And what I'll tell you is the same challenges cut across all the real estate sectors. So what this chart behind me is showing, it's comparing the forward-looking 5-year expectations in each of the core sectors around supply. And it's comparing them to what we just witnessed in the prior 5 years, 2020 to 2025. So we expect the office supply in the next 5 years to be 34% below the last 5 years. Industrial logistics, retail, down about 28%. And the interesting thing, every time the research team at Charter Hall, or we go out to external research houses, recut the numbers, the supply continues to fall. But I want to caution you, I want to encourage you to be patient. Property is a long-term investment, and as we move through the cycle, it does take time for some of these key trends to play out, ultimately in valuations and into unit prices. And where are we at in this economic place? Well, there's a few interesting things going on. Inflation, down, stabilised. Terrific news, tick. That's given our RBA the confidence to drop interest rates. And whether there's 2 or 3 more cuts is anyone's guess. But what I can tell you, decreases in interest rates decrease the financing charge. For most real estate transactions, the debt component is around 25 to 45%. So when you get falling interest rates and financing costs, you get a bigger spread to the yield on the property, you get more buyer depth coming into the market, and you get greater confidence from these large institutional investors to buy assets. And what I think is the most interesting thing in this phase of the cycle, something we don't usually see. Unemployment is still extremely low. 4.3% screens unbelievably low over just about any time period you choose. And then when you couple that with both sides of politics continuing to import highly skilled labour, you see the population growth growing very strongly. And you're going to hear from Samir later on what 1 million extra people means in terms of real estate demand. And he's got a great chart that shows what it means for hospital beds, industrial space, office use. And so before I pass over to the next speaker, just a few words on Charter Hall. We do have 600 property professionals spread throughout the country. There's a number of them in this room today, and I encourage them to make themselves known to the people on the table. We've been doing this for a long time. Traditionally, Charter Hall has outperformed as we move through into that growth phase, which we strongly feel that we're in now. But I don't want to cover off too much of what our next speaker will say, and that's probably a good opportunity for me to welcome to the stage David Harrison. David is Managing Director and Group CEO at Charter Hall. With over 30 years of global experience across all the key real estate sectors, David brings a wealth of knowledge and experience from the top down. And since Charter Hall's ASX listing all the way back in 2005, David has led the growth from 500 million in assets to become Australia's largest diversified property funds manager and largest owner of real estate in the country. David chairs Charter Hall's executive property valuations and leadership committees and serves on multiple fund boards and investment committees. Please welcome to the stage, David Harrison.
Thanks, Steve. Look, there's a few things that I want to talk about today, but there's a couple of key data points I want you all to think about going forward when you invest in property. The first is what I call the yield spread. We've spent a lot of time in the last few years seeing what rising cost of debt does, whether it's residential mortgages, commercial property. There's two things you need to think about with the cost of debt. It's the margin, and across our platform, it's about 1.5%. That's the all-up bank margin we get charged. A few years ago, when cash and swap rates were 1%, you add 1.5% margin to 1%, all-up cost of debt 2.5%. Obviously, that provided a pretty big spread to the cap rate or the yield of the property. Wind forward, we went to, over 4% cash rate, swap rates got into the mid fours, so you add 4.5 to 1.5 and you're at 6% all-up cost of debt. Where we sit right now, we're doing new debt deals right across all of our sectors, averaging about 1.4, 1.5%. So the margin doesn't change much, but the base rate does. So we've seen the base rate, and typically all commercial properties funded off a 3-year swap rate, has dropped from about 4.8 to 3.2 today. So if you think about debt in just two key things, it's this 3-year swap rate at 3.2 plus 1.5, 4.7% is the all-up cost of debt that we can secure on commercial real estate. As you all know, because interest rates went up, all the valuers put all the cap rates up. So on all of your investments, you would have seen cap rates rise. Now we're sitting at a point across all sectors where the cap rates, or that initial passing yield, is well above the all-up cost of debt. And when that happens, you get a positive spread. So when I talk about yield spreads, I'm talking about whether you've got a negative or a positive spread. We've got a positive spread. In addition to that, in commercial real estate, you've got locked in rental growth. Call it 3.5% per annum, whether it's office, industrial, retail, more or less across our $70 billion platform, we're generating year in, year out 3.5% rental growth. So when you've got that rental growth and you can lock in fixed debt for 3 to 5 years at 4.7%, not only is your initial distribution yield pretty healthy, you're going to get growth in that distribution yield. So as you all know, you can look up any one of the funds we have open for investment at the moment, and you can get an initial yield on your money at anywhere between 7%, and I think one of them's up as high as 9%. And that's because we've had cap rates blow out. You saw the price graph. And in my 40 years of experience, what happens when you get that positive yield spread, we're going to see cap rates come down. So you're going to have your asset values growing in line with that 3.5% per annum annual rental growth. But the growth in asset value will be amplified by cap rates coming down. So, as happens with all cycles, that projection that Steve put up is looking pretty positive for all sectors. And part of the reason we're going to see that, we've got a slowing economy. Those of us got money in the bank are going to get less interest on our term deposits than we were getting previously. And then what happens is FOMO emerges. Whether you're a private investor like me, or a big super fund, or a big global investor, fear of missing out emerges and people come back looking to buy real estate. And that's what's starting to happen now. We've raised $3.7 billion of new equity across a couple of our wholesale strategies just in the last 9 months. $3.7 billion. And mostly domestic super funds, but about 45% coming from offshore institutions. So both the offshore people who don't need to buy in Australia, but are electing to buy in Australia because they think it looks good relative to other parts of the world, are coming here. And our own big super funds are also investing more heavily in Australian real estate. So the prognosis is pretty strong for the demand for real estate, the fundamentals, the income line looks pretty good. And your entry point, when you think about cycles, to be able to get into some of the fund opportunities we have at those sort of distribution yields, which are going to continue to grow as debt costs come down and that rental line keeps going up, you've got what we call positive jaws happening. So you've got an expansion in the yield that you'll get on your initial investment as it grows, because your rental growth on top of falling debt costs are going to provide further earnings growth and therefore distributions that we can pay out on the investments. The other thing I'd just like to talk about is, and Steve touched upon it, in real estate, there's lots of, great complex financial terms that they teach us at university. When I went to university, no one could actually even spell an internal rate of return. And now, the institutional market uses IRR, or internal rate of return, to price real estate. All it is a fancy word. It's the combination of the income distribution yield you get plus your capital growth, and that's your total return. So if you can get 6-7% average distribution yield, 3 or 4% capital growth, you're going to get a 10 to 12% total return. At university, we call it IRR, but the way I think about it is, what is the total return I'm getting on my capital between an income yield and capital growth? Where we are in the market, because of the shrinkage of supply, because of continued demand being driven by population growth in this country, and population growth is a multiplier on demand. It's good for, everyone understands it's good for residential, so we've got, residential demand. There's a multiplier effect on population growth, then leading into higher demand for warehouse space or logistics. And the one that everyone forgets about is office. Forget that crazy Victorian government telling everyone that you can work wherever you bloody like. There is a thing that's happening in the office markets, which Carmel will talk about, where population growth, irrespective of how woke a particular government is still driving the demand for office. On top of that, we've had a massive shrinkage in the supply of new office space. So over the next 5 years, we're going to have less new supply able to keep up with increasing demand, and what that's going to do is drive vacancy rates down and drive effective rentals up. So when I think about, just like I talked to you about debt, just think about debt in two pieces. I think about real estate in two pieces. It's the cost of the land and it's the cost of the building. And when I think about the cost of the building, that also includes, the leasing fees and incentives and whatever you've got to lease up the building. And I think about it all on a simple rate per metre. So if you've got a $10,000 a square metre building, take this building. We own the 40,000 metre office building that is essentially above and adjacent this hotel. It's in our books at about 20,000 a square metre. The land component would be 12 a metre. And I couldn't build this building under about 35,000 a metre. But my valuation is 20,000 a metre. Every office asset we own is way below its replacement cost because of what's happened in the last few years in terms of cap rates. And most importantly, the explosion in the cost of construction. Similarly in industrial, your diff portfolios. Virtually all of our stabilised industrial assets have valuations on a rate per metre, averaging about 2,500 a square metre. We could not build that, land and construction, under 3,500 a metre. And in many cases in Sydney, it's probably closer to 4,500 a metre. So we've got a number of positive things that I think are going to combine to be tailwinds for growth in property. The income or yield spread I talked about, the fact that most of the assets are at current valuations well below replacement cost, and because of that phenomena, we're not going to have new supply. You're not going to have crazy entrepreneurial developers that we had in the late 80s go and spec office buildings. I remember one building in Melbourne and one building in Perth being built with no tenants, and then the recession that we had to have, thank you, Mr. Keating, came along, and those buildings sat vacant. It's been far more restrained, the speculative development. So we're just not going to see the oversupply that we've perhaps seen in other cycles, and I think that's going to help drive valuation growth, because if you think about it, you can't have assets 30% below replacement cost and have new supply. It doesn't make sense. So the existing values have to go and move towards replacement costs before you're going to get new supply come into the market. Few exceptions. There'll always be demand from big industrial users. We want to consolidate and get a brand new warehouse, and our industrial team are doing quite a lot of industrial development. But 99% of it is 100% pre-leased before we start construction. Australia is the safest industrial market for development in the world. We have the highest percentage of pre-commitment on industrial development anywhere in any other Western market. So it's one of the things that helps control the risk of oversupply in this country, is that we have grown up getting used to pre-leasing virtually all of our industrial before we start building. So that's value, rates per metre. Last thing I'd say to you is sentiment. We've gone through a tough period. Interest rates have gone up, cap rates have blown out, asset values have come down. Given what we've seen from June 20 to June 22, and you'll remember that central banks basically took interest rates to zero in COVID, we had pretty strong cap rate compression. Then from June 22 to June 24, virtually all of that compression reversed, and the cap rates went back up to where they were in June 20. So right now, retail, industrial, cap rates are about where they were in June 20. The one sector that has been massively oversold is office. Office cap rates have blown out nearly 120 basis points, or 1.2% higher than they were in June 20. Now, you can say there might be a whole bunch of good reasons, including woke government saying you can work from home whenever you like. But the bottom line is it's still got that lack of supply and the demand phenomena that I was talking about across all sectors. So, yes, it's been ugly. I've got my money in our office funds. I'm not happy. But I think the reality is that the prospective bounce back, when you've got cap rates miles above where they were in June 20, and we're virtually at like-for-like interest rates to June 20, I think we're going to see a bit of a surprise in terms of the bounce back in terms of office. And the last thing I'd say is, because we're the largest property owner in Australia, and we're across virtually every core sector from, industrial logistics, retail, office, social infrastructure, we get a lens into 2,800 tenants, what they're thinking about their space needs, their own challenges trying to build new stock, and because of the cost of construction. So we actually have a lens that I think central banks quite often don't, into what's really going on in the economy. And, I do think we are going to see further cuts in interest rates. I think consumption is definitely, particularly discretionary consumption, is going to force the RBA to keep lowering rates. Public sector employment can't keep growing like it has been going. If you take out public sector employment growth, we would be at a 6% unemployment rate. At the end of the day, governments just can't keep printing debt. It's our money. Someone's going to have to pay it, whether it's this generation or future generations. So I do think we're going to see some constraints or restraint in that public sector employment growth, and that's going to start pushing up unemployment, and that's going to force the central bank to keep lowering interest rates. So I think the outlook for all of those reasons is pretty good. We have been through a lot of cycles. I've been through a lot of cycles. And I know it's been, a pretty tough couple of years when you see valuations go down. What I would say to you, and Steve alluded to it, in all your portfolios, all of that institutional wholesale MSCI index, distribution yields have been not coming down. Your yields have been pretty flat. In some cases, they've been rising, then they're starting to rise because of that positive yield spread. So you're going to get a consistent income distribution out of property, and you've got to time your entry and exit so that you're not selling at the bottom. And it's always tempting to do that. I think the prospects going forward for continued distribution, yield growth, and some capital growth are pretty good. So lastly for me, and I know Steve's, thank you. If you are invested in our Charter Hall funds, thank you. If you're not, get in there. You're missing out. FOMO. And, I think hopefully we'll be sitting here in a year or two sort of celebrating the bounce back in returns. And hopefully, as I said, I can sit here and say, those distribution yields have continued to trend up, and you're going to be seeing pretty reasonable capital growth over the next few years. Thank you.
Thanks for that, David. And it's always terrific to hear from someone that's not only steered such a large organisation and with a very large diversified portfolio, but someone that's been through numerous cycles, and to look ahead, all those things David said, I think we're going to touch on in a little bit more detail with our next speaker as well. So I'd like to bring to the stage Samir Chopra, Head of Research APAC for CBRE. Samir is responsible for framing the real estate market outlook and developing economic and property sector forecasts. He's focused on providing unique insights, and having spent much of his career in banking, bringing the discipline of finance to property is one of Samir's key skill sets. Please welcome to the stage Samir Chopra.
Good afternoon. Hope you're well. I'm going to talk about a couple of things. We'll start off just by talking about, what are we seeing in Australia in terms of population growth, some of the demand it creates. What are we seeing in terms of infrastructure spend in Australia? What does that mean for construction cost? And then I'll just go through a couple of the sectors, and I'll finish it off maybe talking about interest rates and where do we think interest rates are going. But we're in a fortunate position. Let's just talk about population growth. Australia's population is expected to grow by about 15% in the coming decade. We will have the fastest population growth of pretty much any country in the world. Our population is growing faster in percentage terms than India, than Singapore, than the United States. We've got one of the fastest population growths. Probably the best way to think about that 15% number is, if you look at that table there, for every 6 of you, there's going to be 1 new Australian 10 years out from now. For the 6 of you, there'll be 1 new Australian in the next decade. Between 2022, so 3 years ago, and 2027, 2 years from now, our country would have added 2.5 million people. We're a small country, right? We're a 27 million people country, small country. We're going to have added 2.5 million people between 2022 and 2027. 2.5 million people is the city of Brisbane. 2.5 million people is the city of Brisbane. We do not have enough, we are not building enough real estate to accommodate an entire new Brisbane. And that is the amount of population growth that's happening. That's why I'm pretty constructive. So we've got very good population growth, but we've also had very good jobs growth in the country. Even through COVID, companies were hiring, government was hiring. We're adding about 2 million, 2.5 million new people with jobs every 10 years. It's that, but we're also paying people really well in Australia. Australia is actually the second highest paying country in the world. Like the wages in Australia, United States is number 1, Australia is kind of number 2. I'm ignoring Dubai and Singapore and all the kind of smaller countries. Amongst the big countries, we're the second highest paying country. And wages today, the average person makes about $100,000. 10 years ago, the average person made $75,000, round numbers. 10 years from now, the average person will make about $145,000. So you've got more population, more jobs, and more income. We think there'll be 960 billion, with like 9 zeros, 960 billion of extra income sitting in the economy, consumption income sitting in the economy. So, I look at this and go, it is really hard to go wrong in real estate when you've got this sort of backdrop. This is also one of the reasons why a lot of international money is trying to invest, looking to invest in Australia. Steve sort of alluded to this. Every time you add 1 million people in Australia, I call this my real estate maths because I'm a simple person. Every time you add 1 million people into Australia, you need to build about 420,000 homes. We're not building them, by the way. We're nowhere near that. But you need to build 420,000 homes. But it's not just homes, because all the discourse is all about homes. You actually need to, for 1 million people, you need to build 3,300 hospital beds. Because every migrant who comes here is also going to get sick, right? Like at some stage. We're not building those 3,000 hospital beds. On my numbers, we might build 3,000 beds, maybe by 2030. You also need to have about 11,000 hotel rooms. Person comes to Australia, they want to go to the Gold Coast, right? So we're not building those hotel rooms. Person comes here, they're going to go shopping. You need to have 800,000 square meters of shopping center space. Just to visualize that, that's like 4 Chadstons or 4 Pacific Fairs. Massive shopping centers. We're not building, not one of them, let alone 4. We're not building even one of those. And there'll be people who get white-collar employment, right? And they'll be working in offices. 800,000 square meters would be about 6 to 8 reasonable-sized office towers, minimum. We're not building any of that either. So I think we're going to end up with this point, and David alluded to it as well. Where population growth is happening, it's feeding demand, and the question is, are we building to that maths? And I don't think we are. The good news, by the way, is as a country, we're investing very significantly in infrastructure. This year, we would have spent about $100 billion on infrastructure. It's doubled. It's doubled over the last decade. And I love that about our country, right? Like, I want to have a great train, good airports, and we're getting that in spades. But infrastructure is also very good for real estate. The real big beneficiary of infrastructure is real estate. With this new metro in Sydney now, it's very easy for office workers in the city to get here from, say, Castle Hill. Increasingly, it'll become very easy for people to get to their office from Canterbury Bankstown or from Parramatta. Likewise, with these new toll roads and that new airport in Western Sydney, it is hugely positive for logistics. We want to have short times and we want to have fast logistics in and out of Australia. But with this infrastructure, this big boom in infrastructure, you've got much higher construction cost. Construction cost, through history, has grown at about 1.5% per annum. Through history, 1.5% per annum. And then during COVID, and with the Ukraine war, construction costs went up a lot. And now it's become 30, 40% more expensive to construct than just 5 years ago. And our view is that, it's not going to dip, it's not going to even stabilize. It'll probably continue to grow at a good clip, say 5%. And the reason for that is all this infrastructure construction. We're about to start constructing for the Olympics in Brisbane. It is going to continue to put sort of upward pressure on construction cost. But what that means, and this is the point David was making about replacement costs, it is really hard today to build something at the same value as the existing building. I'll use, if you look at the charts on the very left-hand side, the columns on the very left-hand side, if you were building a new office building in Sydney in 2020, in your financial model, you needed to get a rent of about $1,200, round numbers, $1,200, break even, you'd build it. and rents were above 1,200. So, it was green light. Let's go and build a project. Today, if you put the same stuff in your financial model, we need to get $2,000 a square meter just to break even for today's delivery. And rents are not quite there. Other than the very best stuff, rents are not quite there. So we think, it'll be very hard to activate new projects. Sydney, you could kind of make the maths work. Melbourne, Brisbane, no chance. The maths is deeply underwater, deeply underwater. And then the question is, how many tenants can you attract at that $2,000 a square meter rent? Not everyone can afford to pay that kind of thing. The best law firms will, the best hedge funds will. So it's becoming really, really challenging to get sort of supply going. I think supply will be deeply damaged going forward. This is all, by the way, good stuff, right? As property owners, what you want is demand is doing this, supply is about to do this. Stephen mentioned, right? Like supply is at least 34% lower and that drives rents and capital values. The other big theme right now in Australia is premiumization. It's almost like FOMO, where everyone wants to be in better buildings, better offices, better amenities. Not just in office, it's the same thing in logistics, in shopping centers, in your homes. And what we saw in office last year in Sydney is that about a quarter of the office stock was actually showing really good rent growth. Despite all the chat about office, there was actually some office buildings, about a quarter of the office buildings in Sydney, that were posting 5, 10, 15% rent growth year over year. And so if you end up owning these assets, these premium, well-located assets within the CBD, you do fine. You don't have an issue. But you've got about a third of the office stock, where rents are actually declining. And over time, this will correct. More of the stuff will end up on that side of the chart. But for now, better location is very, very appealing for customers. I use this chart, this next chart. It's a bit complex, so just bear with me. It has got every different sector in every different city globally. So let's say if you wanted to rent in London a home, or if you wanted to have an office in Paris, or if you wanted to have a logistics site in Tokyo, what was your rent growth last year? So if you're a fund manager and you're sitting in London or New York, this is the chart you look at to say, hey, how is my portfolio doing around the world, every sector? And the point I want to make with this is, I call it the league table of rents. The point I want to make with this is, office, which is in that gray, ended up being top of the league table last year. Believe it or not, office was the best rent performance out of any sector last year. And 2 Australian cities made it into the top 5. Brisbane, that's the very extreme, they had the highest rent growth, and Sydney. So if you're a global fund manager, you're looking at, where do I put my money? Where's rent growth growing at a very good clip? Office moved to the top of the charts, and Brisbane and Sydney lifted. So we think there's going to be tremendous interest in office going forward, partly because it's starting to screen really well. Just on office, one of the things that's happened in the last few years is that little line that goes at the top. That is hiring. That's jobs for white-collar workers, so people who work in the office. You can see jobs have continued to grow. People have been hiring. Law firms are hiring. Accounting firms were hiring. Banks were hiring. So the hiring picture was really good. Government was hiring. But the actual space take-up, which is that line that's going sort of flat, people did not take up office space. So they kept hiring, but they did not take up office space because most CEOs were worried. Do I need the space? Are they going to come back or not? And we are sitting here today, and in every office building, this is kind of the environment. Everyone's back. In Sydney, everyone's back. It's really busy. And we're now reaching a situation where many of our clients are saying, hey, I need more space. And if I was to bring all my people in to the office, I don't have enough space. I'll give you this example. I was speaking to a good friend of mine. He works in Canberra. He's head of one of the departments. He's got 2 teams. He cannot afford to get Team A and Team B in the office at the same time. It's really bad. He's really frustrated, right? And so we just don't have enough space because we've hired, we just haven't taken up enough office space. So we think at some point the bottom moves to the top. People are going to need to start taking up more office space, but the space is not available because supply is getting cut very, very significantly, very, very significantly in the next couple of years. So markets will start to tighten up in office. In logistics, just shifting gears onto logistics, the column chart just shows you vacancy around different cities for warehouses. In Australia, Australia's the dark colored ones. Sydney, Melbourne, Brisbane, Perth, Adelaide. The average vacancy in Australia is between 2.5% and 3%. It's very tight, very, very tight. In Perth and Adelaide, it's about that 1.5% type number. If you go away from that, in Los Angeles, vacancies Los Angeles is a huge logistics market. Same with Dallas, 6-8%. If you keep heading towards Asia and you head towards Tokyo and stuff, it's 10, 11, 12%. If you head towards Shanghai and Korea, vacancy is close to 40%, 40%. Our vacancy, 2.5%. So if you're a global investor, and you look around, you go, what's that market that's really tight? That's Australia. And I think this really helps support rent growth and capital values in Australia long term, because we're starting with a really low vacancy. It's really hard to construct logistics in Australia, and Anna will touch on that. The other big driver in logistics is e-commerce. E-commerce or online shopping is about 13%. So for every $100, $13 is going into e-commerce in Australia. It went up during COVID, and now it's flatlined, and we think it's just about to start taking off again. There's a lot of room to grow. 13% is really light on kind of thing. And the more e-commerce you have, the more choice you need to provide consumers. Like this shirt of mine, if I go into a shop, maybe it comes with cuffs, maybe it doesn't. But when you're buying online, you get all the choices. It comes with cuffs, comes with long sleeve, short sleeve. You just offer a lot more SKU, a lot of product variety. And so logistics becomes more and more complicated, more interesting, and you need bigger space as you start to get online penetration increasing. And just on retail, so just shifting from logistics to retail, retail has been the area charts, the one that's teal colored and dark, shows you retail spend in Australia. We're approaching about $500 billion per annum of total money spent in shops and retail spending. What's fascinating is it's been a really consistent growth. Population growth helps, immigration helps. It just means that it's been this very consistent growth through time, even with high interest rates. It's started to stabilize. It never kind of went negative. It just dipped a little bit, the growth rate, and then we think it starts to accelerate. But the bit of this that I'm really positive about is household goods. We all went out during COVID, and everyone bought a new TV, new sofa, new bed, new barbecue, and so spend took off. And then since then, it's kind of been flat because a couple of things happened. Everyone's got new stuff, and interest rates went up. And now we're reaching a really interesting point. I'm really focused on this right now. We're reaching this really interesting point where people's gear is getting old. The sofa is now 4 years old. The TV is 4 years old. And interest rates are dropping. So my view is that this will shoot back up. It'll shoot back up. It'll be really good for retail. It'll be really good for logistics because it'll pull through a lot of demand that hasn't been there for the last 3 years in retail. I've just got 2-3 other slides to go. One's just on interest rates. This is not updated after yesterday. But we've had 3 interest rate cuts in Australia. I think we're too slow. I think we are very, very slow. We're about 6 months behind where we should be. They should have started a cut late last year, in my opinion. And if you look at the other countries, most other countries, many other countries, not most, many other countries have cut interest rates by 2% already. And they're probably a little bit ahead of where we are. Our house view, and most people in the market expect that there's maybe 2 to 3 more rate cuts to go. I'm a bit more, I have a slightly different view on that. I think we've got another 5 to go from here. Another 5 interest rate cuts, because the economy is very slow, very soft right now. And to kind of re-energize the economy, you need to cut a lot more. Because Australians are very conservative. Even when you get rate cuts, nobody actually spends money. Commonwealth Bank did this. They looked at their own customer base a couple of months back. They'd had 2 interest rate cuts. And what they found is that 90% of people had not changed their mortgage repayments. I'm one of those people, by the way. 90% of people had not changed their mortgage repayment, because people don't. It's not till the 3rd, 4th, 5th rate cut that you go, let me call up the bank and change my repayment. So it takes a long time. The RBA has to do a lot of running and heavy lifting to get the economy going. So, I think I could be right. If I am, there's 5 more cuts to go from here. Let's hope I'm right. And I know you'll all come and talk to me about it afterwards. Last two slides. Where's money coming to Australia? Internationally, the US and Canada are the biggest drivers of capital into real estate. In the first 6 months of this year, about 1.9 billion came from America. So America and Canada remain super, super important. I like that, by the way, because that's fast-moving money. They make decisions. The second biggest pool of money now is coming from Japan. Used to be Hong Kong and Singapore and Europe, and Japan's kind of moved into position number 2. Japan's interesting because it's a lot more sticky money. They invest for a longer time horizon, so I think it'll help underwrite assets in Australia. And then just on pricing, I will give you my sort of views on where commercial real estate pricing is going. The chart on the left shows you what's going on in the US, and chart on the right shows you our thoughts on Australia. I like paying attention to America because the US moves first. They're normally 6 to 12 months ahead of where we're about to go. And in the US, in logistics, the cap rates have already started to compress. They've compressed by about 50 bips. We're starting to see it now coming through in office and retail as well. I used to get no emails on retail. Now I get a lot of inbound, hey, what's going on in retail? So watch America. America's already started to compress on cap rates. And in Australia, our view is that we will get 100 bips, 1% kind of thing, cap rate compression in office and in logistics, and 60 bips in retail through this cycle. Logistics will go first, and Sydney will go first. I always go, sector is important, city is very important. Sydney is where you're going to start to see the cap rate compression first, led by logistics. With that, I think that is me. Thank you for your time. Thanks, Stephen.
Always great to hear from not only a researcher, but from a researcher who brings a global perspective and is outside the group. I'm now going to cover off some of the most common questions myself and the team get asked on a regular basis. We've got more than 25,000 investors across the suite of funds. And so to make my 25 minutes hopefully as useful to you all so that you leave knowing more than what you came in with, I'm going to address each of these hopefully in a logical order, and then I'll cut through to give you a bit of an overview on each of the funds that many of you in the room have invested into. So without doubt, the most common question I'm getting asked lately, talk to me about valuations. How does Charter Hall set valuations? Well, the first thing to note, yes, whilst the board of directors, David's one of them, myself another, and we've got a number of other directors, including the chair and non-executive directors in the room, approve these, there's a very, very clear process. We use external firms independent to Charter Hall, who use valuation techniques like discounted cash flow, comparable sales, cap rate. But interestingly, or less interesting if you're not in love with property, I guess, it's backward looking. It looks at what are the transactions that have occurred in the last 6 to 12 months. Then, picking up what Samir just said in terms of interest rates, well, doesn't a drop in interest rates mean valuations jump? The key thing to note here is that the transmission mechanism is not instant. You heard David talk about confidence, what it does to investor psychology. So as you get that spread between yields of property and cost of debt, confidence returns, transaction volumes in the physical markets increase, and then you get valuations begin to increase. But it takes time. And it's not unusual to see a 12-month lag. So I just encourage you, when you hear our speakers, including myself and Samir, talk today, that it isn't an instant process. So there's time. We're going to work through this in an orderly manner. This isn't a case of next week, because rates were cut today, valuations and unit prices are going to jump, whilst I would love that to be the case. This next slide is a bit more of a breakdown, highlighting what each of the individual sectors did in the direct suite of funds. Hopefully usefully color-coded. You've got the dark blue line, the A-REITs, negative. That's 6 months prior to that, the market got smashed. The red line is our convenience retail, the mustardy color, industrial and logistics, and unfortunately that light blue line is the office market. So you can see here the A-REIT market led the recovery. In fact, it is playing out like we thought it would. A-REITs lead the market. Listed property stocks are more volatile, but they're forward-looking. They don't need to wait for historical valuations to flow through to the stock price. Then we saw convenience, retail and industrial, and then unfortunately, we've seen office being the laggard. And I often get asked, well, Stephen, is Charter Hall and the team just doing these ones, crossing your fingers, hoping interest rates are going to lift all boats? Absolutely not. We don't have 600 property professionals scattered throughout the country just watching what the RBA says and what they're going to do. We're actively engaged. So rather than you take my word for it, I thought it'd be useful to put up a few case studies. So the bottom left shows 3 properties which recently reached 100% occupancy. Let's just pick the middle one. We're in Sydney, 9 Castlereagh. Great asset, typically around 30 to 35 tenants. The team have to work very hard to keep that full. And this is one of the assets that, yes, we are seeing rental growth come through, but unfortunately that expansion in the cap rate has more than offset it. Top right, the Direct Industrial Fund number 4, or DIF 4, recently picked up some highly liquid assets around that $20 million mark because we feel that the valuations have bottomed. This is an example of us trying to not necessarily time the market, but time the opportunities that we bring into our funds. And then the bottom right there, beautiful Bunnings. My wife tells me I need to stop attending them all the weekends, but this is an example of 2 different strategies that we've put together. We've got a great relationship with Bunnings. We're the largest landlord to them. We went to them with 6 assets, shorter lease terms, and we worked with them constructively to extend all 6 assets back out to 10-year leases. This then set up this Taree asset, and through the advice of our investment team, CapTrans, we ran an on-market sales campaign. In fact, it was the first on-market sales campaign for a Bunnings in New South Wales in more than 18 months. And not only did we get a great cap rate, 5%, but we got it at a premium of 4.3% to the prevailing book value. So this gives us confidence in the physical markets for Bunnings assets that not only have they bottomed, but we're beginning to see the first signs of growth. And on the debt side of things, yes, the key is around the base rates in terms of the most impactful. But we don't just sit there and say, well, the margin is what the margin is. We've got a dozen people in the Treasury team in Charter Hall. Many people don't realise, but as the largest owner in real estate, we're also the number 1 or number 2 borrower to 2 of the biggest banks. It means we get great service, great relationships, and we're very key and important customer to them. So the team engaged with the banks, and you don't do that just because you want to have a chat to the banks. No one really enjoys that. But what we did was we were able to get the margins down a bit. We extended out the loan term. That's always cheap insurance. It means you engage with the banks at a time of your choosing. We had great relationships with the banks, and we pushed out our loan covenants. So loan covenants are loan-to-value ratio, interest cover ratio. Not because we had to, because this cycle is very different to the GFC. GFC was like doing 110 Ks down the freeway, hitting a brick wall, and all asset classes got whacked. The market stopped. Debt dried up, and people needed to sell. This cycle, because of what's happening with that interest rates grinding higher, has been a 2 to 3 year valuation trend down. But, as you heard from a number of our speakers already, we are confident that that is about to turn. And so now, this is the 12-month performance total returns, being movements in capital value and the income that's paid either monthly or quarterly for our suite of funds. I always tell people, even when things were great, don't just focus on the 12-month returns, look at the long-term results. But I will pull out a few things here. The first and third highest performing funds, both invested into listed property stocks. Maxim and DVAP3, we launched that actual product because we saw that opportunity in the market, that dislocation in pricing. Pleasingly, all the funds have turned total return positive. Very different story to 12 months ago, except for the 2 office-only asset funds being DOF and PFA. And as I said, Charter Hall are aligned with you. I have this in my own self-managed super fund. Charter Hall put $180 million into both funds in Q4 2021. And as I stand here now, continues to hold those same investments since that was made. But I always tell people, look at the long-term returns. So this chart shows the blue line, which is the performance and total return of each fund since inception compared to the grey benchmark returns. And whilst I'd love 100% of funds to exceed the benchmark, we do have 90% exceeding it. And this also applies to funds which are no longer in existence. These are funds where we raised capital, bought assets, managed them, sold the properties and returned the value. 16 of 18 of these historical funds also outperformed the benchmark. And as I said, you'd love it to be 18 out of 18, and we do everything we can, but sometimes whether it's a sector-specific challenge, like office, or an asset-specific thing, it means it can't occur. Another question myself and the team regularly get asked, well, Stephen, what's happening in terms of distributions? Well, we don't guarantee distributions. We're not providing term deposits. But even through the fastest increase in interest rates in more than 3 decades, all our funds have continued to pay distributions. Yes, we've adjusted some along the way as interest rate hedges have rolled off. But pleasingly, that's been very consistent. And I'm not going to name competitors, but there are competitors in the market who have turned off distributions completely the last few years, either because they thought it prudent or the decision was taken out of their hands by their banks. And this next slide, I just want to highlight the distributions for the 5 open funds. And if you're like me, you look at your investments, whether it's CommSec, NabTrade, there's a nice little chart there. It shows you your purchase price, the current value, and whether you're green or red. But what it doesn't show you is what the income I've banked on my Commonwealth Bank or BHP. So you can see here, this is the accumulated distributions in cents per unit for our 5 open funds over the last 5 years. Despite the challenges we've had in valuations in the office sector, a fund like DOF has paid the highest cents per unit distributions. And we are expecting the current level of distributions to continue for the next 12 months. But look, We want to be conservative. We don't want to get ahead of ourselves. And should things change, positive or negative, we do always reserve the right to amend those. But we have been through a detailed bottom-up process where those budgets have been tabled to the board and the distribution outlook approved. And what is the forward-looking return profile? Well, that's even more challenging to answer. I'm not going to sit up here or stand and give you the 12-month unit price target. If I could tell you what the unit price would be with definitive answer in 12 months or 18 months, I'd probably be doing something else. But what I can tell you is we do spend a lot of time on that active management, looking at those trends and positioning the portfolios to benefit as we move into that upswing. So as I stand here today, I have a lot of confidence that we've hit bottom valuations for industrial logistics, convenience retail, and A-REITs still have some growth potentially still to play out. Office came off a little bit at 30 June. And whether there's a little bit more to go at December, I do not know. But what I do have a lot of confidence in, if we're not at the very bottom, we are so close. We are seeing the big institutional investors deploying into this sector. We're seeing that across industrial and the convenience retail as well. I'm now going to spend a little bit of time going through the funds that many of you in the room have invested into. The first fund I'll talk to, Direct Industrial Fund number 4, DIF4. I love acronyms, I shorten everything. 59 assets, $3.3 billion portfolio. I would argue that this fund was disproportionately hit in terms of valuations. What happened? In an increase in inflation and interest rate environment, you saw very strong levels of rental growth in industrial logistics. And Anna, I'm sure, will touch on that. What it meant was suddenly what fell out of favour was long-term leases to high-quality tenants in institutional quality properties. We saw cap rates blow out 150, 200 basis points. But the rental growth wasn't enough to offset that. As we move into a more stabilised market where interest rates are coming off and inflation is flat, we do expect in the physical markets that demand to return more strongly for the higher quality industrial. So that fad of investing in any grade of industrial asset, trying to chase that short-term lease to a dubious tenant because you want that pop in short-term rental growth rates, we think that trend is played out. And I don't want to today just repeat statistics that you all get in those quarterly reports. And if for some reason you're not getting those reports, do flag it to the team and we'll make sure that's fixed. I want to talk to things that you may not be aware of. So this fund has a 71% tax deferred rate. We're not allowed, we can, but there's too many disclaimers to put forecasts and targets of tax deferred. What I can tell you over long periods of time, it's averaged 40 to 60%. Some of you may be accountants, some of you may be financial advisors who are very across this. But for those in the audience who aren't, the way to think of it is this. I'll give you an example. Let's say a fund paid 10 cents distribution in FY25. If you had 71% tax deferred, that means 7.1 cents of that income you do not pay tax in FY25. Instead, it comes off your cost base, meaning that if and when you sell this fund in the future, if you're in a zero tax rate environment, as many people have in terms of their retirement strategy, or if you've held it for more than 12 months, you get a 50% benefit. So we haven't changed the strategy for DIF4. I think it's important you have the courage of your convictions, and we are confident that the high quality assets that DIF4 invests into will rebound as that cycle turns. So we are staying with long WALE assets. We will pick up quality in markets where we're high conviction in, like those 2 acquisitions I mentioned before for DIF4. Moving now to our diversified fund, the Long WALE Fund, or LWF. In hindsight, this is a fund I should have talked to more. It's diversified. What it meant was that myself and the team could tilt allocations as we move through cycles. This fund has outperformed the MSCI benchmark since it was first launched. And you can see there that beautiful color wagon wheel where we've highlighted the convenience retail in red, industrial and logistics in mustard. And even though it has some office exposure, Because we were able to tilt it, get into social infrastructure, this fund has outperformed the benchmark. Similarly, it had 100% tax deferred. I don't encourage you to expect that because it's very challenging to predict it. Always think of around that 40 to 60% is the long-term average. But if you are in this fund, it meant all the income that you would have received in FY25, you wouldn't pay tax on in that calendar year. We are being patient as well. And I'll give you an example of something we've been patient on. This fund has a CBD Brisbane retail asset. Fantastic location, but it's been disrupted right now by that Cross River Rail. That's a piece of infrastructure that's key to that city. But we're very confident, we've done the work, we've looked at the analysis. We think that the return upside, despite having to help some tenants at the moment, is very strong when you can put a McDonald's, a KFC, a Burger King sitting in that CBD location almost on top of that station. So this is an example of us taking a long-term perspective, not trying to just generate a short-term gain, but looking at property how as it should be for that 5 to 10-year investment. Moving now to the direct office fund. $1.9 billion, 5.8-year average lease term, ironically exactly the same tax deferred rate as I went through on Diff 4. It's got a 5-star energy rating. And we don't focus on energy ratings because it's popular or trendy. Yes, it's the right thing to do. But importantly, the type of tenants we want to target at Charter Hall, whether they be government, ASX top 200 entities, they require it. If you want to make the short list for their occupancy requirements, you need to have strong neighbours energy and water ratings. So this is a journey we've been on for more than a decade. And it means we continue to stay relevant and can attract those tenants. If you requested a redemption, I understand that the first payment will be made next week, 30%. We always said we expect the redemptions to be paid out in 12 months. The majority of investors did elect to remain in this fund. So we're being patient. We're selling assets on market where we think the value's been maximised or we think that it has some issues potentially around that longer term thematic. And we are being patient. One of the mistakes a lot of managers made as they exited the GFC was they continued to sell assets as the market was performing. So you wore the impact of gearing as markets went down and you didn't get that benefit as you moved into the upcycle. So one of the things DOF is very focused on, it's got 3 great assets in Sydney CBD, Newcastle Ray Street, 68 Pitt Street and Shelley Street. We're very confident that they will deliver rental growth and we are refocusing this fund back towards that CBD market. I had an investor ask me prior to this meeting around the long-term forecasts. Well, look, we may provide options to merge funds in the future, but at this point, we're looking to navigate through and sell assets to meet some of those redemptions. We are raising capital at a 2.5% discount to the prevailing unit price as well. Moving to the PFA fund, well, it sold all the non-core assets that we wanted to make. Redemptions are fully completed. There's one potential asset down in Adelaide that we may look to move on. We expect to extend the lease with the government there for a 5-year period, and it's likely at that point that value's been maximised. But we will always keep an open mind. We aren't emotional about property, whilst we do love it. If we can sell something at a value that we believe is higher than its intrinsic value, we will look to move it on. Very similar on what we're focused on in terms of DOF, high energy ratings. The team actually did some work, looked at all our tenant customers, and regardless of whether you're in office or industrial, it was 60% plus of all of our tenants had net zero or carbon targets. And in many cases, the only way these businesses, such as law firms, accountants, can achieve those is in terms of the space usage that their business or office utilises. So we are looking to retain gearing around that 40%. Our funds, our open funds have a 30 to 45% target. As I said, we've worn the impact of gearing on the way down. And I think as we move into the upcycle, I just encourage you to be patient. Moving to the Maxim Property Securities Fund. This fund is a little bit different. it was one of those top 3 performing funds in that last 12 months. A-REITs are listed on the Australian Stock Exchange. They provide great liquidity. In fact, you can get liquidity in T+3. So 3 days after you request it, the portfolio managers in Charter Hall sell the stocks and you get your money back. But it does come with more volatility. What I would say, some of the large A-REITs in this market are still trading well below their NTA. So whether that's an opportunity or not, look, I'll leave that for people to make their own view, but there is still, in our view, opportunities in that space for high quality stocks where valuations have bottomed or very close to bottoming, and you're beginning to see, as part of this result season, some announcements around rental growth or FFO growth. For those of you who are in the wholesale property series, this is only available to wholesale investors. WPS1, WPS2, they'll both set up the same way. Basically a capital raise period of 2 to 3 years, a management period of 3 years, and then that last 3 years is an orderly sell down so that at the end of that period, the fund winds up and you've been returned capital along the way over that 3 years. WPS1 is the first fund that's now approaching that redemption window. And what we expect to do prior to Christmas, 10 to 20% of that fund's portfolio will be returned back to investors, exactly how we said it would do. Then over the next 2 years, we'll pick and choose the timing when we can deliver that liquidity based on the other underlying funds as we move through the cycle. Both WPS1 and WPS2 have outperformed the MSCI benchmark, and we've had a lot of financial advisor and high net worth demand. We will be launching a WPS3 at the start of September. And myself and the team did debate whether we wanted to talk about new investment opportunities. But remember how I said I was going to cover off some of the most frequently asked questions? Well, without a doubt, the most common question we get asked are what new products you have coming up. And many of you have been with us for more than a decade, and I don't want you to hear about our new products speaking to an advisor for the first time, or seeing it in the paper or an advertisement, or speaking to a friend. I think it's on us, Charter Hall, to make sure you're aware of things coming up. So I'm going to show you a short video on CHOT3. It's a 2-asset office syndicate. In fact, only in the last 12 months have we got back into providing syndications. Syndications, by their very definition, are a much more condensed, less diversified portfolio. But we're at that point in the cycle where we're seeing opportunistic style returns from core real estate. So I do expect over the next 12 months, there is a window to continue to offer this kind of product to the market, and then we will likely pull back from it. So I'll put up a short 2-minute video on CHOT3, but please do continue to eat as your meals arrive.
Introducing a limited investment opportunity from Charter Hall. Charter Hall Office Trust Number 3 is open to wholesale clients, targeting attractive returns through high-quality Australian office real estate. CHOT3 is a 5-year investment targeting a strong annual distribution yield, paid quarterly, and a competitive total return target. CHOT3 is backed by interests in 2 prime office assets, secured below replacement cost and well under peak market value, with growth potential supported by strong tenant demand and limited new office supply pipeline. With properties located in 2 of Australia's strongest performing office markets, Brisbane and Canberra, CHOT3 benefits from strong market fundamentals and blue-chip tenant occupancy. Located in one of Brisbane's key growth areas, 900 Ann Street is a prime office tower in Fortitude Valley, close to the CBD, public transport, and the popular James Street precinct. The asset is well placed to benefit from infrastructure investment leading up to the 2032 Olympics, with the Olympic precinct only 1 kilometre away. The Louisa Lawson building at 25 Calishaw Street, Tuggeranong, was purpose-built for its anchor tenant, the Australian Federal Government. Found in the heart of Tuggeranong's government precinct, the prime office asset boasts 100% occupancy and features strong environmental ratings, a key factor in attracting and retaining government tenants. Ready for the growth phase? Chot 3 is open to wholesale clients, targeting a 10% annual average distribution yield, paid quarterly. To prime assets, 100% leased to blue chip tenants. Now's the time. This is where.
Big disclaimer, ignore everything that I've said. And as I seriously did mean before, please don't take anything as financial advice. You should always read everything in full and speak to your advisor. I do want to highlight a couple of other things which will be launched in the next few weeks as well. So just last Friday, Charter Hall announced that it had raised more than $1.5 billion for some of Australia's largest and global institutional investors into a convenience retail portfolio. It's targeting a 12% equity IRR, excuse me, which is total return, and a through the cycle distribution average of 6%. These are some of the most defensive property assets you can get. They are things like your neighbourhood shopping centres, Bunnings. These properties are located in great catchment areas that are irreplaceable and well below replacement costs. So there should be 3 of these on each table. If it is something you're interested in, please do scan the QR code, and when we have those offer documents and the presentations available, we will send them out. And as I said, I encourage you to read them in full. And the reason why the big institutional investors are moving now, they've seen the bottoming in the cap rates, they've looked at that through the cycle chart that I put up, and they've got strong conviction. And these are very sophisticated clients who have already invested $1.5 billion and likely to top up going forward. This now brings us to the next part of today's session. We're going to have it a bit more relaxed, a little bit more of a discussion. We're going to cover off some of the most frequent questions we get in the 2 sectors. And so oddly, I'd like to introduce our next speakers up to the stage. The first is Carmel Hourigan, CEO for Charter Hall's office business. She brings with her 30 years of experience in the real estate investment industry, spanning key senior leadership positions and roles in funds management across public and private markets, investment, research and advisory services. She's also currently the National President of the Property Council of Australia, having been appointed in 2024, and she's a former Deputy Chancellor of Western Sydney University. The second panellist is Anna Maras, who's Head of Asset Management for Charter Hall's Industrial and Logistics Division, around $26 billion of assets. She's responsible for the sector-wide strategy of asset performance, upgrades, leasing, driving portfolio quality, tenant retention, rental growth, and returns. Very busy roles both of them have. And this is a little bit different in Sydney. I've got a little couch. I'll see how I go. We've touched on this, but I want to get a bit more into the detail. Where do you think we're at in the valuation cycle? And we'll start with you, Anna, in the industrial and logistics space. We've heard from speakers today. What are you seeing on the ground across the portfolio?
Thanks, Steve. I thought I might just start by setting the scene for the audience that the industrial and logistics sector is really now seen as essential infrastructure for the economy. So it's no longer a discretionary asset class for investment. And it's really underpinned by that movement or distribution of goods around Australia, that rise in e-commerce, and the growth of the urban population that Samir talked about. When I'm talking to our tenant customers day in, day out, and they're the brands that you know and love, it's Coles, it's Woolworths, it's Bunnings, they're telling me that they are investing more in their real estate and supply chains than ever before. So it's a bit of scene setting. If you look at the graph, what you'll see is that we reached peak for capitalisation rates at about June 22. And as Steve said, it moved out somewhere between 150 and 250 basis points in that time. And obviously we saw some movement in valuations. What really defended that for industrial is that we saw the most significant rental growth in history. So I'm talking about somewhere between maybe 20 to 30% year-on-year rental growth, and that defended values. And why did that happen? So we saw vacancy rates get as close to zero in some states. So if we were here kind of 3 years ago, Sydney got to a vacancy rate of 0.2%. In addition to that, we saw demand grow exponentially. So it went at about 1.5 times the 10-year average. So at around 4.2 million square metres of demand. And the reason why is we saw that disruption in the supply chain. People needed to store more goods in their warehouses. And then we all went online and started shopping. And there was that exponential growth in e-commerce. And that prompted demand. Where we are today, as Steve said, is we've got to that cyclical upswing phase. We've seen 2 periods of normalisation in the valuation period. And for the whole Charter Hall book across industrial and logistics, we've seen investment now come back from both foreign and domestic superannuation. So we've seen about $1.5 billion invested in the last 9 months. So that's a bit of scene setting, Steve.
And Carmel, you've had a pretty tough gig the last couple of years navigating the office markets, and whilst occupancy's been kept very high, what's your view and perspective on where we're at in the valuation cycle?
You know, I think we've heard it quite a few times today. The market really is starting to change in terms of office, and I think when we came back from the Christmas break, I have to say we all felt a lot better in the 140 people office team we had. And David, the CEO, mentioned this earlier, but if we just simply look at how far valuations have gone in office, it's a major reset. Even in the GFC, the global financial crisis, we never saw valuations move like we have in office on a downward trajectory. So we've probably seen ranging somewhere across, just a range of assets, because don't forget, we've got over 100 assets on our platform. We're the largest office manager in the country across all states. We've probably seen somewhere between that sort of 20 to 25%, within our portfolio and across the market. You've even seen some larger falls than that, depending on where your assets sit. So that's on average where we've got to. And as a result of that, we are seeing cap rates or yields for office now even softer than they were when they were sort of June 2020, and all other sectors have actually recovered from that point. So it does sort of say to us that office has been negatively impacted by a lot of sentiment. And in particular, we did see a lot of negative sentiment washing through from the US markets. And a lot of the global investors are very heavily, and Canadian investors and US investors, obviously very weighted to that US office market, which was fundamentally hit like very, very hard at the beginning of COVID. And as that washed through, the US, Europe, into Asia and into Australia, we've sort of had that lag effect come through. I would say, though, that we are very different from some of those other markets for various reasons, and we can talk about later in the presentation and maybe through Q&A. And we are seeing now, and I think Anna just touched on it as well, we're seeing a fundamental change in how capital's starting to think about it. So the conversation about what actually looks like good value at the moment, office is looking like pretty good value when you look at it across the other sectors.
Okay. And look, I talked about supply in my introduction. Samir talked about it. David talked about it. But let's get into the detail a bit more. What are you seeing around the supply for each of your sectors? And why don't we start with you, Carmel, this time?
Yeah. The supply constraint that's come through the Australian office markets is the biggest green shoot that we could ever be given. The fact of the matter is construction costs have risen around 40% from where we were at the beginning of COVID. And that has fundamentally changed the landscape for people who are trying to develop office stock like ourselves. If I just give some examples, if we have developed office assets in Melbourne, Sydney and Brisbane in the last 4 years. So we're probably one of the only developers that's successfully been able to do that. And a number of those developments we actually sort of started just coming into COVID. So we've been able to complete those nearly 100% lease, but it's been very, very hard. If I had to develop those buildings right now or build some of those buildings, some of the construction costs, for example, in Melbourne, I would have been building a commercial office tower in Melbourne for around $6,500 a square metre. That's just the construction cost. That's not the overlay of everything else, which David was talking about earlier. If I had to do the same tower now in Melbourne, my construction cost would be up in like $9,500 to $10,000 a square metre. Sydney, we're currently building Chifley. Once again, we've seen a significant rise in construction costs in Sydney. And what that means is the economic rents that we need, and Samir talked about break even, we wouldn't do anything for break even. We have to actually make a profit. And so when you see those charts from CBRE that are talking about rents in Sydney CBD needing to be up at $2,000 a square metre gross, actually, they've got to be up at $2,600 a square metre. They're not, down at that level for us to do something.
So can I ask, a couple of investors I spoke to as part of today's event asked about Chifley. So how does it work? Like, we are building it. We're not losing money.
It does work. It's that is a fantastic project. And I would say it's unique, right? The reason why there's only 2 big office developments going in Sydney CBD at the moment is, in some ways location, asset specific, and there's historical reasons for that. One of the reasons why Chifley is really working well for our investor base is that when we bought Chifley Tower, the North Tower, we effectively picked up the site. We didn't pay for that site. That pad site was basically the barbecue area. Free land. And we would say that our fearless leader, who's not here now, we have to pay him this one, he actually did pick that up, that maybe, maybe we could actually build a new office tower on this barbecue area. And so we went and actually got planning approval. We got that approved, and now we're building a 50,000 square metre tower. And as a result, the land value that's gone into that feasibility, it is all it's representing, that land value, is the fact that we've had to demolish part of the podium, we've got rid of some of the retail at the moment, and that's the cost in that VSO. So our profit on that project is significant. So it works. And when we think about the rents, though, that we've been able to achieve, we've achieved record rents in Chifley. So we're already 55%, nearly 60% committed by income. But there are other towers at the moment in Sydney CBD, the metro towers, and there's 2 metro sites that people are looking at the moment. There's probably 1 other tower. And the type of rents that are being quoted for those rents, which will be a 2032 project, we're talking $2,800 a square metre. Chifley is averaging around $1,900. But just to show you the growth that you're going to have to get in office rents to justify some of the construction at the moment that's being proposed, which won't even hit until 2032. And what that means is we're going to see net effective rental growth in existing assets. It's just pure supply and demand. It's going to drag up existing assets because there won't be new supply. So look, for these reasons, we do think that and not all parts of the market are recovering at the same level. We have to be very careful at the moment, more than ever before, where we go, which asset, which sector of the city, but it's actually looking very strong.
Yeah. And I'll just highlight that the valuations follow cash flows. So ultimately, if you get higher rental rates, higher net property income, that will flow through to valuations over time, but it's not an instant transmission mechanism. So Anna, we talked a little bit about it before, but I think this chart shows it well. Supply in industrial, speculative, pre-commitment. How are you seeing the market?
I'd love some of that free land, can we just say? Because when you look at land and the rise in the cost of land for industrial over the last 5 years, it's risen about 16%. So much like office, we need certain economic rents to make developments feasible. There's a few barriers to that really make it difficult to continue to bring on supply. And when you look at supply compared to what Samir talked about in terms of population growth, I don't know if you can remember that number, but it's a real tailwind for rental growth and values. So the first thing is it's challenging to bring on what's called employment lands, or they're lands that are zoned for industrial use. the government's been really focused on housing affordability, but probably not remembering that we need to put maybe employment land near where we're putting new housing estates. So that's pretty critical to have zoned land. The second thing is that we need to be able to service that land. And that's simply just bringing in roads and what we call catalytic infrastructure or servicing of that land. That's power and water fundamentally. Within Sydney, we saw probably the test case of what not to do. In the outer west of Sydney at an area known as Kemps Creek, if anyone knows it, it's kind of 25, 30 minutes out on the M4 motorway, where there was around 850 hectares of land that was rezoned. What happened to developers? Charter Hall decided specifically not to participate in that. But what happened to developers in that area was that Sydney water surcharges went up substantially due to their period of ownership. And it's been challenging to really bring on that supply. And that supply was going to cope with some of the demand that I've been talking about. The last thing I just want to point out is on this graph, you'll see the dark blue component. I think David spoke about it at the start, but that's the percentage of pre-commit in the market. So if you look at 2024, it's largely pre-committed at about 80%. And then you can see that downward arrow. We're going to reduce supply between 25 and 26 by about 30%. So it's going to bode well for continued rental growth.
That's true, and I'm sure Carmel's heard exactly the same in her role as National President, but I'm involved in the PCA for New South Wales, and there is very much a conflict between getting out the homes, which is great. We need to increase the home supply. People need places to live that are affordable, and what would normally traditionally be areas that would be zoned for industrial and logistics uses. So that conflict is occurring and everyone's trying to work through in the way that balances it out, but that is also one of the challenges we're witnessing. Carmel, we've talked about supply, so let's move on from that. If you had to pick two key things that are influencing the office sector to make our audience aware of or give a bit more, what would those two things be?
I thought the best way to show this is actually what we're doing on Chifley. So this is actually what we show our tenants when they come in and they want to actually take space in Chifley. And what we've seen since, maybe it started a decade ago, but we've seen a change in the type of amenity that people want in their workplace. And right through, so as we went through COVID and people wanting to bring their staff back, we found that they wanted to have increased amenity. Some of the experiences which their employees had at home, they want to experience in the office. So it's all about talent attraction and bringing people back. And what we are seeing is that in a lot of instances, companies are making the decision, you know what, I'm not going to have 3 locations in Sydney. I'm going to have Sydney CBD and it's going to have all the bells and whistles. And so we've got this, the two things are really this flight to quality, and you're seeing Chifley here at the moment, but you're also seeing all this additional amenity that's coming through. Now, costing that has been difficult, but we've actually come up with models where actually in many cases the tenants pay for this as a service that comes through the building. But we are seeing this massive shift where people are moving out of secondary assets and they're actually taking advantage and prepared to pay a higher rent to get this type of amenity for their staff. So that's why secondary absorption in Sydney CBD has been so negative, and positive absorption, which obviously we have majority of prime assets, has actually been positive. And we've seen this around the country. And so for us, we've been able to maintain our vacancies, our occupancy levels at 95% on average across the whole 100 assets, for the last sort of 5 years. And that is because we have continued to yes, you've got to spend a bit more capital to maintain it, but they're competitive. I also think that the trend that's going to come from this is we're going to see a lot more obsolescent stock. So you're seeing a lot of discussion at the moment in certain states about conversion. And sounds really good on paper, and you see it in New York and everyone's converting their old office buildings to residential, but it is difficult to do that, and some of the layout of the buildings, the way the windows are and all these sort of other things makes it quite difficult, and location to actually convert things to residential. So we'll have some obsolescence.
And we've voted with our feet in this in many cases. So I'll give you 2 examples. Direct Office Fund, DOF, in the last 18 months sold 2 great assets actually, 200 Queen Street down in Melbourne and 1 Nicholson Street also in Melbourne. Not because they weren't still leasing up strongly, they both were, But we're looking at the average age of those properties. One Nicholson, first skyscraper in Melbourne, probably tells you everything you need to know about its age, heritage facade. And we're beginning to see CapEx costings from Carmel and her team and the technical advisors that we thought were going to outweigh some of the free cash flow for that asset. So that's an asset I've really loved, great outlook, but in our view, it's the kind of asset that it made sense for us to move on, and we want to reinvest those proceeds into more modern kit. Same question for you, Anna. Industrial, 2 trends excluding supply that you think are driving where the market's going.
Yeah, thanks, Steve. So probably focus first on e-commerce, and I think between Steve's wife, Carmel, and I, we're keeping e-commerce statistics fairly high. I know there's...
Bunnings is in person for me. I can't pick out.
But this generation, this next generation coming through, known as Generation Z, anyone that has children or grandchildren potentially between the ages of 13 and 28, I'm pretty far away from that now, but the way that they are consuming is fundamentally changing. So you'll see that I'm often telling my son to get off his iPad, but they're really changing the way and the nature that they will shop in the future. And that is going to change technology. This is highly interrelated to the video that we will now play relating to automation and robotics. So what we're seeing flow through is a requirement of a need for goods to be delivered faster. So if I went on Amazon this morning, I can get my goods, as an example, by this afternoon. If I'm shopping Coles online, and there's some examples of what Coles have done with their Ocado facility in the western suburb of both Sydney and Melbourne here, it shows you the way that they are distributing goods, or they're fulfilling customer requirements. And that means that I might say, oh, I forgot the milk or I forgot the bread and I need that by tomorrow morning. So used to be 4 days, went to 2 days. Now it's kind of, I need that in 2 hours. What it means is that automation and robotics are being heavily invested by our tenant customers. And that investment is often really 2 times the value of the underlying real estate. We'll see this evolve significantly. Diff own an asset in the southeast of Melbourne with Woolworths. Just to give you some perspective, that has 14 kilometres of automated conveyor zigzagging across that warehouse. There is a robot there that can pack about 650 cartons an hour. That's 4 times the amount of manual labour. This is just growing, and it's changing and evolving and shaping the way and look and feel of industrial, I think, for the future.
And there's even a practical element. Look, whilst I was still going to the shops, I've got 3 young children, youngest 2, 4 and 7. I don't want to take them to the shops on a Saturday. Like, we can sit at home, order the Woolworths, and it comes the next day after work. I'm going to mix it up a little bit here, get you out of your comfort zone. So beside your own sector, so no office, no industrial, what is your preferred sector and why? Keep the answers short, punchy. Carmel?
Industrial. I think it's that sexy video we just saw. No, it's, if we look at the re-rate that we've seen in industrial, yes, it's had a big re-rate. And yes, we've had double-digit rental growth coming from industrial. So it's been, just an amazing sector over the last sort of 5 years. I still think, although we're looking out now with a bit more supply, we actually have, vacancy rates which are some of the lowest in the world. We've got a long way to go before, the rest of the world would beat us in terms of logistics. So I feel like we've had a bit of a re-rate in terms of, the yields, the initial yields going in, but we've still got, effective, rental growth that's coming through the industrial sector. We sort of budgeted around 5%. Now we've had double digit and all that sort of stuff, but actually if you look at it, a 5.5% ingoing for a really good quality shed, ingoing pricing, and then you're actually adding on your rental growth, it's still a very solid return with fundamentals that are strong.
Same question, Anna, and you can't say office because Carmel just said it. Okay, you can.
For me, convenience retail. So a few things: bulletproof income. It's anchored by those majors that we know and understand. It's your Coles, your Woolworths. And then it's got your specialty retailers. So Carmel and I can get our meat at the butcher on the weekend, for example. The other thing that is, I hear that there's no incentives, which I think would be nice. So Convenience retail for me. Thanks.
Okay. And I'm now going to invite Samir back to the stage. I had a look on the break with getting so many questions come through. So Samir, I welcome you back. Feel free to send any more questions through. I'll also now take the opportunity to invite Jonathan Williams up to the stage. Jonathan was appointed fund manager for the direct business at the start of this year. He's been with us for 2.5 years now and brings with him more than 15 years experience. Prior to coming into the direct business as fund manager, he was looking after $9 billion of cross-sector real estate for some of our largest institutional clients. And as you'd expect, with a company like Charter Hall with 600 property professionals, we do like to promote within. And I'll also set him up here in advance. Any tough questions, feel free, bail Jonathan up, post the event. Whilst I'm always available, I think it's good for him. It's good for him to hear these questions. So, Samir, I might throw to you first. We've had a few data centre questions come through. What's your view on data centres and why?
Yeah, look, I think data centers, big growth market. Substantial amount of capex going into it globally. I'd say there's kind of one or two things just to be mindful of. One is, to get into data centers now, it's a 500 million to $1 billion check size per asset. Whereas you can always buy a logistics asset at $25 million. So you get liquidity versus it's tougher to sort of get in. The other one, Anna and I have been chatting about is data centers are very close to power and telecoms. So they're not easy to build. So I think data centers will do just fine. And industrial is another way to benefit from data centers.
And I might just sort of tack on the end there. At Charter Hall, we don't doubt the need for data centers. It's pretty clear what's happening with the need for information. What we are a bit more circumspect on is what's the terminal value for these type of assets in 15 or 20 years at the expiry of that hyperscaler type lease. And when you start putting the huge capital sums on top of the land value, we think there's other ways to play it. Typically, we'll rezone the land. Jonathan, welcome to the stage. I had a question on those two Diff 4 assets acquisitions that I put up earlier. Yep. The question is around, they seem relatively small.
Yep.
Why would a fund such as Diff 4 look to invest into assets of that kind of ilk and size around?
So over the past couple of years, we've sold a number of those subscale assets in that sort of $25, $30 million less price point. We think it's important to replenish that stock. That type of stock can trade through cycles. And what that means is there is a market correction like we saw over the past 2 to 3 years. Those type of assets at that type of subscale has a broader buy range, and private buyers can come in and buy oftentimes with cash. So it allows us to get that quick liquidity as opposed to some of those bigger assets which might require a little bit more liquidity and at times might not be as quick insofar as transactions. So that's why it's important to replenish some of that subscale asset size.
Next one, very topical. I can't seem to not read about it, even if I want to. Impact of tariffs across the sectors and across the market. Might start Carmel and work our way around in the office space.
Look, I think for office, maybe I'll just talk about it from a capital perspective, because we're not really seeing an impact on a tenant customer perspective and a demand perspective in the Australian market. But from a capital perspective, so incoming capital into the Australian market, we think we're actually going to be a net beneficiary of tariffs. And we have all recently been on tours to Asia, met with sort of circa 35, 40 Asian-based investors right through Singapore into Malaysia, Korea, into Japan. And I would say every single one of those investors would say to us, one, we're worried about the state of the US in terms of the volatility and just general decision-making and tariffs. And as a result, we are looking to treat Asia-Pac as our priority one market. And as a result of that, anyone who's doing an allocation to Asia-Pac from a global fund will look at a proportion into Australia. So We think we'll get a disproportionate share of money looking to move away from that volatility. I think if I had to say which markets Asian-based investors from an office perspective are focused on, they're focused on Sydney CBD, Singapore and Seoul. So they're the sort of three markets that they're generally looking at.
And industrial?
From an industrial perspective, less than 5% of our exports are to the US. So there's been and we are talking to our tenant customers every day so far as their view on the impact to their business. I just want to give the audience some perspective. I sat with the COO of Primo a few weeks back. Primo is the largest distributor of meat goods, including pork. He was explaining to me is China, in a bit of a tit for tat on the tariff regime, has stopped importing pork from the US, and their volumes to China have grown by 60%. So in some instances, it's actually been, as Carmel said, a net beneficiary.
And capital flows, do you think this has, Samir, had any impact? You had a good slide on capital flows. Do you think what's happening, I guess, with some of these big trading partners is going to benefit us or impact us negatively in capital flows?
Yeah, I think the flip side of tariffs is many countries are now having conversations about taxation and unwinding taxation. The US is unwinding levels of taxation. I think Europe is unwinding levels of taxation. I hope that comes into conversation in Australia as well. I think we're all very regulated and it's affecting productivity. So part of the tariffs, the opposite side is, let's talk about de-taxing and letting business prosper.
Okay, the next question's a fund-specific one. So, Jonathan, can you explain the key difference in performance between, say, Diff 3 and Diff 4, and what has caused it?
Yeah, so Diff 4, as Steve, you mentioned during your speech, has a long WALE, 10 years. And over the past 2 to 3 years, given the fact that, it's had long WALE to core, high quality tenants, it's had annual fixed increases of, call it 3.5%, which hasn't been enough to offset a rise in interest rates. So that's been Diff 4. It's somewhat underperformed against Diff 3. Diff 3, on the other hand, has had the benefit, in particular in the West and Sydney, where they had a number of shorter term WALEs as well as mid-term market rental reviews, where we were able to capture some of that rent review uplifts, sometimes up to 30, 40, 50% in some of those assets. And so that's why you can see clearly Diff 3 is one of our better performing funds across our suite of funds, and in particular in the industrial sector, as it's outperformed benchmark pretty clearly.
Yeah, and it's a much more concentrated portfolio. So if you have one or two Sydney assets that jump 40% in value, it materially moves the total fund returns. Any comment from any of the speakers regarding AI and impacts on the property sectors moving forward? Anyone want to have a go at that?
I'll start. I love AI. I'm trying to use it every day, and I would encourage everyone to be using Copilot as much as possible. And we're just testing a lot of this stuff at the moment at Charter Hall. It was interesting. I was at a conference the other day, and they were saying, they had a number of speakers from Department of Industry, Science and Technology in Canberra. And they were saying, if you're not looking at your platforms and saying, okay, I'm going to look at AI, I'm going to do a review, and actually you're not looking at that every 3 to 6 months again, you'll actually fall behind, because that is the rate of change. But this question was asked in that forum, and it was full of tech heads. And the view was they didn't really see much change in the beginning, what was going to happen to employment numbers or so on from AI. We think we all need it from a productivity point of view, and this country needs to have some sort of step change to get the productivity moving. But it may, I suppose my personal view is, and what we're seeing on the ground in real estate, it's basically enabling us to do our jobs more efficiently. And then from there, we're actually redirecting our staff onto more value add. And so what it could do over time is, maybe it actually slows down some of the hiring in different areas. But actually, and Samir, you had a good stat on this, when you actually look at the growth that can come out of being really strong at AI, I mean, just look at the US. I mean, they are leaders in this space, and the amount of growth coming from some of these other industry new types of companies and so on is massive. So I think it's a positive. I do not see it as a negative at all.
I think it's also helpful when when these companies become more profitable because of AI, they've got more bandwidth to spend on premium office. So the staff you have are more highly paid, and you can locate them in better offices. So I'd say it's going to be net positive for office as well.
Okay. A question that's come through a number of funds. When do you expect to see an increase in distributions for PFA and the other suite? Look, I might jump in here. We are trying to be conservative here. We didn't know when and how fast interest rates would drop. We've had a number of interest rate hedges roll off. So I think you should be looking at FY26 as continuing the current rate of distributions pretty much across the suite of funds. We think that's a prudent way to do it. The board did discuss this, but rest assured we are looking at driving not just the valuations and unit price over time, but also that rental and ultimately distribution growth for our investors. Maybe, Jonathan, I'll get you to answer this one. It sounds like assets are held at very conservative values. If these values were revised to be more current, would this not raise asset prices?
Yes.
Okay.
I was a valuer when I first started my career in the industry, so I can speak from their lens in some form. You're like, Steve, exactly what you said in the preso, they are backwards looking. Sometimes they'll look 12, sometimes they can look up to 24 months backwards, right? So if you want a forward-looking indicator, look at what's happening with our listed funds and look what's happening with Maxim and those type of real estate property securities. Unfortunately, valuations will always look backwards. We'll never have to change that. But if you look at the listed side, that gives us really good confidence that we are at the next cycle.
Yeah, and I would say just to build on that, we don't hold values in the funds at conservative or aggressive valuations. We hold them pretty much without fail based on the independent valuation firms that we've appointed. So whilst we'll always review them, and across 1,600 properties, we have the ability to spot outliers and things that don't make sense. At Charter Hall, we're not taking a view to push valuations aggressively or conservative. It is a matter of an outworking of these external valuations. Carmel, for you, how much existing older office buildings can be repurposed? And how do you think this could impact on supply?
Look, I think if you've got a well-located, because you're not going to get that much new supply coming through for all the reasons we talked about earlier, if you've got a good quality A-grade building in a good location within a major CBD, then just based on where rents are going, yes, there is benefit in actually refurbing that asset, and you should be able to actually fit that within the portfolio. We certainly do that. I mean, across the group, we must have $300 million worth of refurbishment projects going at any one time. So we're constantly, upticking foyers and so on. What we have seen recently, and we took a major corporate tenant in Australia through some of this the other day, is we're taking fit outs which people leave behind and we're renovating the fit out. And so we're uplifting the fit out, and tenants are actually quite focused on that because they actually think, oh, I'll take that fit out. We'll renovate it so it's not costing us as much, and then we give them less incentive, and they take that incentive as an abatement or a rental abatement. So they're actually reducing their rent load for the next sort of five years. Generally, someone taking an existing fit out is sort of a 5 to 7 year tenant. So yeah, we are seeing that, but I would just say we have been very careful. If you look at the growth of Charter Hall, you'll see, yes, we've grown, but we've sold a lot of assets. We're probably the most active transactor historically in office. And so you'll continue to see us chop the bottom off. And we have to do that, right? Just to make sure that we're only focused on the best ones. We will still have assets now that we look at and go, when the market starts to pick up, you wouldn't do it now. When the market starts to pick up, we'll look to get rid of some of those assets too.
Look, I've probably got time for one more question. There's more on the screen here than we're going to have time to answer. So if your question wasn't asked, please, it's not been ignored. We just want to make sure we get people out in a reasonable basis. Myself and the team will be around after as well to answer anything else. But the last question here was around why doesn't WPS1 own some of that Telstra Trust and it would have benefited from it. The short answer is it does own it, and it was a net positive contributor. However, it was part of a diversified cross-sector allocation that WPS series invested into. So look, with that, please put your hands together and we'll thank our panelists for their time today. Now that concludes the formal part of today's session, and I want to thank you all again for not only being supporters of Charter Hall, but for taking the time to be with us here today. I hope you've enjoyed the food, the discussion, and you ultimately leave today knowing more about real estate than when you entered these doors. So on behalf of myself, the direct business, and the wider Charter Hall Group, I want to thank you all. And if you do get an email with survey results, I just encourage you to please complete it. It's feedback we take seriously. We want to build it into next year's event to make sure that we're providing as much value, interest, and hopefully entertainment for you as we can at these events. So thank you very much.